coming up on Retiring Well with Michael Reese.
You need to be much more diversified than that. You need to have a range of investment strategies, all doing different things. The key is with your retirement, you want to make sure you have the right amount of money in each of those categories.
What if you could use different strategies that have different pluses, have stronger elements of maybe, let's say, safety and growth to offset that one that maybe has a stronger element of growth and liquidity?
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and I am really excited about this week's show. We are talking about something we call the three worlds of investments. In other words, we have found that there are essentially three different worlds or categories, if you will, that you can put your money. And each of these categories or worlds, they have their own characteristics, and it's important that you understand how they work. So, where did this all come from, by the way? Well, it came from when I was a kid. You know, when I was young, I had a paper route, and I remember that the deal I made with my parents was, hey, whatever money you earn, half of it you've got to save. But the other half you can spend however you want. Well, I was, 11, 12, 13 years old, and what did I want at that age? Well, with the 50% that I could spend on my own, I clearly wanted candy, because that's what kids that age want. And I would go in the local IGA store. And in IGA was, Independent Grocers Association, if you don't know what that stands for. And when you walked into that store, they had this little sign. It was a little wooden sign in the window as you walked in. And that little wooden sign said, great service, lowest prices, high quality. That sounds pretty good, right? You get it all. But then below that sign were three little words. Just three little words, but they taught me a lot. They said, pick any two. In other words, no, you can't have it all. There are trade-offs in life. Well, guess what? The same is true with investing. Whenever you invest your money, there are three characteristics, just like the great service, lowest prices, highest quality. There are three things, and those are growth potential, safety of principal, and liquidity. Liquidity basically means how fast can you get your money if you need it. So growth, potential, safety of principal, and liquidity. And just like that sign in the door, pick any two. All right, so whenever you invest money, most people are most familiar with what we would call the investment world called growth or risk. It's a world that's all about growing your money. So if you think about it, when you start out saving for your retirement, you probably are adding money to, say, a 401k or a 403b or an IRA. Where are you investing? Well, probably mutual funds, right? And when you put money in this category, what are the two things you're picking? Well, you're looking for growth potential, and you also have liquidity, because there really is no safety of principal when it comes to mutual funds. Remember, they say things like past performance is no guarantee of future results. They tell you that if you read the prospectus, they tell you you can and will lose money from time to time. But that's okay with you, because when you put your money in there, you know in advance that some years you're going to make money. In fact, some years you're going to make a lot of money. Those are fun years, right? But what else do you know is going to happen over the years? Some years you're going to lose money. Some years you're going to lose a lot of money. But what you do is you're thinking, I understand this when I put my money in this category. You understand that. And what you're thinking is you're saying, okay, that's okay, because over time, the good years and the bad years will kind of balance out. And over time, you should have more good years than bad years, and over time, you should make a pretty decent rate of return. That's the hope. There are no guarantees on that. I mean, you might be up 40 one year, you might be down 40, but over time, you're trying to get a decent rate of return. Usually, most people we talk to say, you know, if we could get that 6 to 10% return, that would be great. Now, you have growth, you have liquidity. But what don't you have? You don't have any safety of principal. And as you get closer to retirement, you start thinking in the back of your mind, now wait a minute. I remember the last 20 years. Over the last 20 years, this category has lost 50% of its value twice. And it's about once every 10 years, it loses about half of its value. It has a really bad down market. And you start thinking as you get closer to retirement, you're saying, okay, wait a minute. I don't have the time to make up for those losses like I once had. Might be time to start moving money out of, might be time to say, I don't need all my money in growth. Might be time to start moving money in some other categories. And I don't want you going anywhere because later on in the show, we're going to talk about what those categories are and how they work.
Hi, my name is Larry Flynn, and I'm one of the advisors here with Centennial Wealth. Listen, if you're soon to be retired, 5-10 years out, or in retirement, there are some critical concepts that you need to understand in making your retirement vision a reality. Don't be complacent about this. There's so many things that you need to understand. And we're putting a presentation on all across northern Michigan at venues such as this so that we can get in front of you and share some of these things with you, give you some valuable information in hopes that maybe you want to hear a little bit more or go into detail. These are not high-pressured events. We just want to get in front of you, give you some good information, and if there's a chance you might want to meet with us, great. But if not, then at least you've walked away with some valuable information and a gourmet dinner at that. So listen, want to personally invite you to this. Appreciate you coming. Please answer the call on the screen. Thanks.
Hi, I'm here with Larry Flynn. He's one of the advisors at Centennial Wealth Advisory. And Larry, I know you and the other advisors, they do a lot of public discussions, a lot of public seminars on financial matters regarding retirement planning. Can you share with our viewers a little bit more about, what do you talk about, and what kinds of topics can they expect to hear you speak on?
Mike, we put on a 1-hour presentation, and I'll talk about a number of various topics, from taxes to the new fiduciary standard of care, just a number of things that we believe are critical in making somebody's retirement vision a reality.
So this is all about getting them good information in today's world on a variety of retirement topics. That's right. Now, a lot of these events, I know these folks are out there watching us right now. I know what they're thinking. They're thinking, Larry, I've been to these before, and usually it's really nothing more than someone trying to sell me something. Can you maybe respond to people that think about that?
Yeah, I'm really surprised by that. I hear that all the time. Hey, I went to these before. They hard sold me. They were trying to pressure me into making an appointment with them. That's not what we're about. Just want to give them some good information. If they see something from the presentation that they might want to hear more about, then great, we'd love to meet with them. But we're not going to meet with somebody that doesn't want to meet with us. We're not going to hard sell them into having to come to our office.
Yeah, why waste time chasing down people who don't want to talk to you anyway, right?
That's right.
Well, that sounds great. So, Larry, I know you do these throughout all of northern Michigan. For those folks watching that think, hey, I'd like to attend that. Does it cost anything, by the way?
No cost.
So they're free. So they think, okay, it's free to go. I'd love to go, learn a little bit, maybe have a nice dinner. How do they find out more information, like when these events are and how to register? What do they need to do?
Well, they can call the number they've been seeing on the screen during the program. Okay. They can visit the website, www.sen-wealth.com.
All right.
Yep.
So website, phone number, either way, they can get all the information they need. Is that right?
There you go.
All right, there you go, folks. Sounds to me like it'd be worth your time to attend. You've got nothing to lose. And hey, maybe you'll find out some great information that helps you make your retirement better. Thanks, Larry. Today in Chalk Talk, we're going to do what I call play financial tic-tac-toe or investment tic-tac-toe. And I know this looks like a tic-tac-toe board, but what we're really talking about is, in today's episode, safety of principal. So S stands for safety, G stands for growth potential, and L stands for liquidity. And the reason I have this set up this way is whenever you build a portfolio for yourself, we want to make sure that we are using different strategies so that we create a balanced approach in all of these components where we have a certain amount of our money safe, we want a certain amount of our money growing, and a certain amount that's liquid, right? So why don't we go ahead and take a look at this? So I'm going to start up here with strategy one. And strategy one is where you have certain investments where they have growth potential and they're also liquid. Well, why do you think I'm starting with strategy one, growth potential liquidity? I'll tell you why. Because that's pretty much what you probably mostly have. If most of your retirement money is in like a mutual fund portfolio, in a 401k or an IRA, or maybe you've got some portfolio at an after-tax portfolio, but it's all stocks, bonds, mutual funds, guess what? You already got a bunch of this strategy one. You already have a bunch of that stuff, money that has growth potential and it's liquid. You already have that. You know what you're missing? Safety of principal. Right? So how do we fix that? How do we fix that and do so in an intelligent, balanced way? Well, the next strategy we might want to employ is we may want to say, well, wait a minute, we need some safety here, right? And you still probably want some growth. It seems like everybody wants growth. Growth is, I want my money to grow, especially in today's market environment, right? So you might apply a second strategy. You say, okay, I'm going to take some of my money and I'm going to put it in some type of an account where your principal is protected. That's important. And you're still getting some growth. But guess what? If you're going to do that, what do we have to do? We have to give up something. In fact, I should probably go over here and say, here we've got an X, meaning we don't have that one. Well, where's our X over here? It's right there, right? Meaning, there's no such thing as a free lunch. There's always something missing. So here, my mutual funds and my 401k, they give me growth, they give me liquidity, but they don't really give me safety. Well, maybe we want to find some kind of investment opportunity out there that says, okay, we'll protect your money, we'll give you some decent growth, but you got to give up a little liquidity to do it, right? And then, of course, what's our third one down here? Not a bad idea to also have some of your money where it's safe and it's liquid, right? You want to have some of that too, but if you do that, what are you giving up? Well, we got to sacrifice a little bit of growth there. Whenever you build a retirement portfolio, whenever you're trying to structure your finances in such a way that you get the best chance of your money performing for you so that it supports the goals that you have for your retirement, you need to have a balanced approach, right? You need to be diversified. And diversification doesn't just happen by saying, oh, I've got stocks, I got bonds, I got mutual funds. No. You need to be much more diversified than that. You need to have a range of investment strategies, all doing different things so that you create an environment where no matter what happens in the markets out there, no matter what happens, you got a bunch of your money safe, you got a bunch of your money liquid, and you got a bunch of your money with growth potential. Now, you can't have it all, but if you're smart about it, you can balance these in a way where it really supports your retirement goals. How do you do it? You got to come in the office, you got to visit with us so that we can help you design this specifically for your needs.
Centennial Wealth Advisory, your independent retirement planning specialists, now in 3 convenient locations in northern Michigan. 818 Red Drive in Traverse City, 3890 Charlevoix Avenue in Petoskey, and 3687 Old 27th South in Gaylord. Contact us at 888-608-5825 or visit send-wealth.com to schedule your no-obligation complete retirement review at any of our Northern Michigan locations, Traverse City, Petoskey, or Gaylord. Centennial Wealth Advisory. Your best is yet to come.
Hi, I'm sitting here with Larry Flynn. Thanks for being here, Larry.
Thank you, Mike.
He's one of the advisors at Centennial Wealth Advisory. And folks, as you may know by now, we certainly invite you to come visit with us. It's absolutely free to get a second opinion on your retirement planning. And I think it's important to get a second opinion from someone who's a specialist when it comes to retirement planning. And Larry, I'm sure they're wondering, if they pick up the phone and they call and come visit with you, what can they expect? What's that experience like?
Well, Mike, they can expect not to get hard sold, okay? We're going to greet them warmly. We're going to sit down and talk to them a little bit about maybe their story, where they're from, where they grew up, how they met their spouse, what they're dreaming of doing once they get soon to be retired or retired.
Kind of what are their goals, right?
Yeah, what are your goals? We're going to talk to them a little bit about who we are, what we do, show them how we do things, especially dealing in the market realities we find ourselves in today.
Got it. So essentially, they're coming in, you're learning a little bit about what's important to them, what their goals are, what they're trying to accomplish. I'm sure you're taking a look at what they're doing so far. You maybe share a little bit about you, and it's just in a very relaxed atmosphere.
That's right.
And there's no cost to do this. Is that correct?
No cost. No cost.
All right. So, folks, there you go. I mean, it sounds very simple, very easy, very laid back. There's no reason for you not to just pick up the phone, call the number on the screen, come visit us, get that second opinion. You'd be glad that you did. Welcome back. This week we are talking about what we call the three investment worlds. And again, just going back to all investments have characteristics or components that make them up. And in the investing world, it's growth potential, safety of principal, and liquidity, or the ability to access your funds easily. We've already talked about the growth category, which is about growth and liquidity. So what's on the opposite end of that? Well, on the opposite end, we have our world or our category of safety of principal. So generally, when you think about investments or accounts that are safe, what we're talking about here is we're talking about money that is safe, absolutely your principal's protected, and it's liquid. So in other words, we're safe and we're liquid. So that means we're giving up some growth potential. Now, what am I talking about here? Well, clearly I'm talking about things like, bank accounts, checking, savings, CDs, money market accounts, maybe some fixed annuities or cash value life insurance. We're talking about things where your principal's protected or guaranteed, and it's still liquid. You can get your money if you need to. Now, of course, that brings up a problem, right? So we had talked about when we're talking about the world of growth, that the concern was, well, great, we understand that over time we can get a better rate of return, but the closer you get to retirement, and even if you're in retirement, suddenly time, that magic four-letter word, that component you really need for that category, you don't have the same time to make up losses that you did when you were younger. And you start thinking, well, gosh, you remember the last 20 years, market lost half their value twice. Then you think, I should probably start moving some of that money over to where it's safer. And so you often look at the world of safety, which are bank accounts, money markets, etc. Now, I know that this is how you do it because people come in the office every day. So people just like you, they're watching the show like you are, and they say, wow, I want to talk to maybe someone on our team. So, you pick up the phone, you call us, and you come in for a free visit. And when you come in, we see, you show us your accounts, and we see, oh, look, you have money that is in the markets, and then you have money that is safe, because this is exactly what you've done, and that safe money is usually in, say, money markets or cash. I mean, that's pretty common. That's very normal. But so that's the world of safety. The problem, of course, though, is that world of safety is really designed for short-term needs. It's not designed for retirement investing. And so the returns, you don't get the returns, and that can be a little bit of a challenge on your retirement planning. All right, that brings up our third world, or our third category. And we kind of call this the hybrid category, because what's happening in this, it's in this middle world. It's kind of a combination of growth and safety, because what's happening is, remember, we have the three components. We have growth potential, safety of principal, and liquidity. In this middle area, what we're doing is we're essentially giving up some of our liquidity. We're saying, you know, we don't have to have all of our money liquid, and we would rather have growth potential and safety of principal. That's more important for part of the money. Now, in this environment, you might have principal guarantees, you might have earnings linked to markets, but this is an area where you're trying to get a better return on your safe assets. And there are, if we talked about this earlier, you might earn you're trying to target 6 to 10% in the growth side of the equation. In the safety side, if you're today's world, if you're getting 1%, that's good. In the middle, we're just trying to get something in between there and do it consistently. The key is, with your retirement, you want to make sure you have the right amount of money in each of those categories. And that's why people come visit with us, is to make sure that they're in good shape there.
Hi, my name is Larry Flynn, and I'm one of the advisors here with Centennial Wealth. Listen, if you're soon to be retired, 5-10 years out, or in retirement, there are some critical concepts that you need to understand in making your retirement vision a reality. Don't be complacent about this. There's so many things that you need to understand, and we're putting a presentation on all across Northern Michigan at venues such as this so that we can get in front of you and share some of these things with you, give you some valuable information in hopes that maybe you want to hear a little bit more or go into detail. These are not high-pressured events. We just want to get in front of you, give you some good information, and if there's a chance you might want to meet with us, great. But if not, then at least you've walked away with some valuable information and a gourmet dinner at that. So listen, want to personally invite you to this. Appreciate you coming. Please answer the call on the screen. Thanks.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Welcome back. You're here with John Torbett and Larry Flynn of Centennial Wealth Advisory in Northern Michigan, and we're looking forward to going over a few new things here, Larry. So on today's show, we've been talking about safety, growth, and liquidity. So I want you to sort of dive into that a little bit further here.
All right. Well, John, I don't care what financial instrument you're looking at out there, right? It's going to have a strong element of 2 of the 3 of those, right? Sure. Remember that sign we'd see in the stores? It'd say price, quality, service, pick any 2.
Sure.
It's the same thing in the investment world. Take a savings account, for example. Fully liquid, yep. Fully safe. You got FDIC insurance, right?
Sure.
But are you going to get any growth right now?
No.
No. Take a portfolio, stock bond mutual fund portfolio, right? Okay. It's fully liquid. Yep. Great growth potential, because I might be able to make 40-50% in a given year, right?
Right.
But what don't I have?
You're giving up that safety.
That's right. I could lose 40-50% too. There's financial instruments out there like annuities, for example, sure. That offer absolute downside protection, maybe some adequate growth, but what are they always asking for?
Oh yeah, you're limited on what you can ever draw out of those.
Right.
So.
They make you stick in for a time frame. You're giving up liquidity. So I don't care what you're looking at, you're going to have a strong element of 2 of the 3 of those, right? So what we want to ask people is, what is a couple of the ones they feel stronger about?
Sure.
If they're near retirement, well, don't you find it the case that most people want
That's safety.
that
right?
safety, right?
Yeah.
I mean, they want that one. So maybe now it's a leveraging act between the other two. Maybe on some accounts we might give up a little liquidity, but for growth, but try to balance that out a little bit. But it's going to be a leveraging act.
Right, right, yeah. You don't want to get too overweighted in any one category, and that's where it's a little challenging sometimes when we're sitting down with folks and they've come from that world, the 401k world, where it seems like a majority of the focus is on that growth piece, and so they may be pretty much all in an equity type portfolio, or even some of the equity bond portfolios where their whole focus is trying to get that big growth, and they aren't really exposed to what those safe alternatives may be, right?
Well, it's that old adage. They've got all their eggs in one basket.
Right.
And that might bode well if things cooperate for them for that one basket. But what if they don't?
Oh,
They've got all their eggs in one basket. If I had all my eggs in the basket of real estate and I'm operating in 2008, how glad am I?
Right, right. Yeah, yeah. You want to have that diversification, and that's where it's important, like you were saying earlier, of recognizing all investments have advantages and disadvantages, and it's a matter of weighing those disadvantages to recognize, okay, well, can I live with that disadvantage, maybe just for that piece of it, knowing that, okay, I've got these over here to maybe offset that, right?
That's right.
So.
That's right. We often hear people, when we use the word diversification,
Right.
they'll immediately go to, well, you're talking about the diversification of my stocks, right, and my bonds, right? Well, wait a second. That's all, as far as we're concerned, that's for the most part one bucket.
Right.
Right? That's one strategy if you've just got a mix of portfolio. What if you could use different strategies that have different pluses, have stronger elements of maybe, let's say, safety and growth, to offset that one that maybe has a stronger element of growth and liquidity, right?
Exactly.
Diversifying the strategies, and I think people will find that they'll have much better outcomes.
Well, and that's where I think of, like, a lot of times people will ask, oh, I've got this investment, is that good or bad? And we look at it, we sort of look at, all of them are just different investment tools and all serve maybe a different purpose. Like someone that maybe had real estate during 2008, okay, yeah, as long as it was a piece of the overall mix and sort of blended in.
Sure, that's right.
Yeah.
That's right.
So yeah, so it's important again to just sort of evaluate all those different factors: safety, growth, liquidity. Make sure that there's going to be disadvantages within certain investment tools, but recognizing that you can't just put all your eggs in one basket. Is that fair to say?
That's right.
All right. Well, good. Well, appreciate you tuning in. And again, John Torbett, Larry Flynn with Centennial Wealth Advisory, and we hope you continue to tune in next week. Thanks again.